If you're in your peak earning years today and you're 55 years old, but then at 60, you're going to fully retire and you're going to have zero active income, what's your taxable income going to be at age 60? Probably not very high. Maybe you have a pension. Okay, we'll give you that. Maybe your pension's giving you $20,000 per year. But that's it. Maybe you've got some dividends coming in on a brokerage account or interest income coming in on a money market or CD or a taxable brokerage account. Okay, maybe those total up to be about $20,000. So maybe all in, you're making $40,000 of earned income on your tax return and you're married filing jointly. What's your tax bracket? Your top marginal rate, 12%. So which one's higher? 32% or 12%? Obviously, this is an extreme example, but this is a very common example. So my question is to you, does it make sense for you to pay taxes at your current rate in order to have tax-free growth in the future? Or does it make sense for you to actually take that tax deduction at this 32% bracket and then take that money out when you're down here in this 12% bracket?